1. Air Products, the up-and-coming hydrogen energy giant. Today we want to share with you an analysis of a company we've been following for a few months now. This isn't a call to action, but rather a breakdown of an interesting business that may give you ideas for your own investment research. Amid the hype surrounding tech stocks, it's easy to overlook promising opportunities in other sectors. Air Products and Chemicals, APD, is a company that could be one of the leaders in the energy transition to clean technology. Why APD deserves attention? Air Products is a global leader in industrial gases, with more than 80 years of history. The company not only serves traditional industries, energy, healthcare, manufacturing, but is also actively investing in the hydrogen technologies of the future. Here are, in our view, the key advantages of the business model. 50% of revenue comes from long-term contracts with guaranteed payment. Customer cost shifting mechanism protects margins. It is extremely difficult for new companies to start competing with APDs because it requires huge investments in production and decades to build relationships with large customers. Stable growth in EBITDA margin from 25% to 44% over the last 10 years. The company delivered impressive financial results in the fourth quarter of fiscal 2024, adjusted earnings per share growth of 13%, EBITDA increase of 12%, increase in margins by 4.6 percentage points to 44.1%. An important strategic move was the sale of the LNG division to Honeywell for $1.8 billion, which will allow the company to focus on its core business and the development of hydrogen technologies. For fiscal 2025, management forecasts APS of $12.70 13.0, which implies 6.9% year-over-year growth. Growth drivers will be expansion of gas production capacity, investment in membrane technology, $70 million, growing demand for biogas and hydrogen solutions. The potential of the hydrogen market deserves special attention. Projected volume by 2030 $600 billion, expected to grow to $1 trillion by 2050. First mover advantage in partnerships with major customers. The company's strong financial profile is represented by the following data. S&P's A credit rating, $2.99 billion in cash, net debt, EBITDA ratio of 2.8x, dividend yield of 2.3%, 41 years of uninterrupted dividend growth. The company only devotes 57% of its earnings to dividends, which means there is a good margin of safety and room for further increases in distributions to shareholders. But, of course, there are risks to investing this idea. Setting up large-scale hydrogen production facilities are complex multi-year projects with potential for schedule delays, budget overruns, and technical difficulties in startup. Dependence on regulation and government support, geopolitical and economic uncertainty, competition with traditional energy sources. The following conclusions can be drawn for a potential investor. At the current price of $312 and a forward P/E of 24.2x, APD stock cannot be called cheap. However, the company offers a balanced mix of growth and income, with projected earnings growth of 10–16% over the next 3 years. For long-term investors looking for a quality idea in the energy transition sector, APD could be an excellent choice. The review is for informational purposes only and is not a personalized investment recommendation. Any investment carries the risk of capital loss. 2 technology stocks will rise in 2025 due to the monetization of AI. For those interested in the earnings growth outlook for tech companies, we suggest reading our opinion on the subject. Profit growth driven by the monetization of artificial intelligence will be a key barometer for tech stocks in 2025. The excitement around the AI story has been a major driver of strong stock returns in 2023 and 2024, thanks to promises of significant productivity gains. According to Barclays analysis, global AI-related stocks have returned 16.5% over the past year, significantly outperforming the MSCI ACWI index's return of 6% on an equal-weighted basis. Until now, the benefits of the AI revolution have been largely concentrated in hyperscale companies and foundational hardware players such as high-tech giants and semiconductor companies. However, since the recent election, the software sector has pulled ahead of these groups. Barclays notes that this shift has been driven by multiple expansions fueled by advances in artificial intelligence technologies, from generative AI pilots to new agent-based AI. Barclays analysts expect these agent AIs to lead the next wave of leaps in functionality and adoption, which could herald further gains for these stocks. In the stock market, the Dow Jones Index extended its losing streak to 9 consecutive sessions, the longest streak of declines since 1978, and the Nasdaq 100 Index, which is dominated by technology stocks, fell 0.4%. The focus is on the accompanying Summary of Economic Projections, SEP, which is likely to set expectations for the year ahead amid steady inflation and strong economic data.